Interested in real estate? How about wealth? Well, they go hand in hand. And here, you'll learn all about it. Welcome to Be the Bank, a podcast where we discuss and debate the topics centered around real estate investing. Your host, Justin Bogard, shares insights into investing in real estate to create real wealth and passive income for you and your family. He'll share stories of real estate investments done right, walk you through the process of owning a real estate note, and most importantly, educate you so you can be the bank. This is Be the Bank, brought to you by American Note Buyers. Now, here's your host, Justin Bogard.
Hello, it is episode number 5 of season 5 today on the American Note Buyers sponsored Be the Bank podcast. Today, we're going to be discussing kind of some news and events that are going on in the country today as it relates to mortgages and the note business. We're going to touch on origination loans, newly originated loans versus seasoned loans as well. So stay tuned. Hey, Richard, how are you, my man?
Pretty good, sir. And you?
Great. Yesterday, it pegged 70 degrees here in Indiana. Can you believe that?
That is amazing. North of San Francisco, it was 45. So 30 degrees difference between here and there. And it's, what we're thankful for out here, but is amazing is that by this weekend, the Sierras will have gotten over 10 feet of snow.
10 feet. Wow.
10 feet of snow. That's a lot of skiers out there are having a good time.
So is it safe to say it's 10 feet taller now?
Yes, it is. It is. It is. To that effect, the Himalayas are getting taller every year.
Is that because the earth underneath it is pushing it upward?
Very good. Very good. Yes.
He has been teaching me on the side.
I know my geologist other half would be proud of you. It's because it's subducting and getting moved up. And I can't remember. I think it's 4 or 5 centimeters a year that the Himalayas move up.
Yeah. This is totally true. This is all fact. This
is big stuff.
Well, it is. We're recording this here in March, so in about a month, we're going to be going on spring break. So the girls have their spring break the first week of April, and we are going to be going to. Well, I decided, and they're cool with it, to go to a baseball game up in Detroit. And so the Red Sox will be playing up there, and that's kind of my favorite team. So when they are local, why not?
I'm looking all over here. I don't remember seeing a request for that across my desk.
Oh, put it in a time off sheet?
Yeah. Where is this? Huh?
Well, I guess you just found out. That thing better be approved.
You have 2 choices. You can either do that or you can invite me, which was better. You better get the handwriting out very quickly. No.
Oh, that's going to be an expensive flight out there for you from good old Petaluma.
Yeah, especially since I don't follow baseball.
Right.
So what's going on in the conventional market these days?
Well, I saw a news feed that came across, I don't know if I was looking on Facebook or just on Google or Firefox, whatever I was on, but the owner of the Cleveland Cavaliers is Dan Gilbert.
Mm-hmm.
And Dan also is the owner of Rocket Mortgage since I think 2020.
Okay.
And so you know how Rocket Mortgage did really well during that super low interest rate time frame, which was the 2020 time frame.
Most mortgage companies worth their salt did.
Yeah, and they made a crap ton of profit.
Yeah.
Well, the opposite happened in the fourth quarter of 2022.
Oh, can you imagine?
Yeah, so they reported a loss for the first time since Dan's owned the company. I believe. I'm trying to remember what I read, so if I'm wrong, I apologize. I'm not trying to give a quote here, but I believe they had $481 million in total revenue for that quarter, and they lost $493 million.
Last time I looked it up, that doesn't work.
No, it doesn't work. So I am making assumptions here, Richard, and my thought is that the most glaring thing to me is we're not having nearly as many refis as we did during the super low interest rate time frame that happened a few years ago. So
Right.
the only thing I can imagine is that refis are down just so significantly that it finally showed up on the balance sheet for these mortgage companies, specifically Rocket Mortgage.
So if you wanted to go out and get a new home mortgage today, less than a jumbo, what do you think it would cost you 20% with 20% down in your area?
Like the interest rate, is that what
Yeah,
you're asking?
that would be not the APR, nothing fancy, just the flat out rate.
We've been hovering around 6.5 for a while. It's
Oh,
got up to
okay.
7, been over
Yeah,
7 for a little bit. It jumped
yeah.
down, I think, closer to sub 6.5. So
Okay.
I haven't looked in the last week or so, but I would venture to say it's probably between the 6.5 to 7 range. I did see a little blurb today too when I was doing some research that said the Fed is probably going to start hiking the rates back up. I've heard rumors that they feel like they've controlled inflation enough to where they
Mhm.
feel more comfortable to jump rates back up. So we may see a dance from 6 to 7%,
Yeah,
maybe for a while, Richard. I don't know.
yeah. I mean, this is a technical term I'm going to use, but I think the economy is playing nanny with the Fed.
And
Like,
you can't.
you raise the rents, or not the rents, you raise the rates, and you want me to go down? Well, guess what? I'm going to tighten back up. And the unemployment is now at 6.36%, which is as low as it's been in the last 20 years. So nanny.
Yeah,
Kind of amazing. I don't. It'll be interesting. Obviously, they can't publish these stats on a real-time basis because they can't
right.
collect them quickly. But in the next 3 or 4 months, we should know why and what part of the sector um, this is coming from. I have been reading of late. I think some of us have read some of this and suspected this, but weren't
Mhm.
necessarily knowing about it. But rather than calling it the Great Resignation, they're calling it the Great Reset. Case in point, my neighbor has a very nice um, upper end restaurant here in the Petaluma area, and during the pandemic, his executive chef quit,
Okay.
and he had a whole bunch of time in his hands, and he went back and taught himself coding, and he's now making $150,000 a year, which is just as much as he was making before. And he's not working until midnight every night, not on his feet. Now, I think a lot of people have quoted the coding thing, but from what I've read, there's just a lot of resetting going on. That a lot of people are just taking jobs that they still liked, or they liked. Maybe they weren't making quite as much money, but they haven't gone away. They're just reset.
So are you saying that you're seeing people resign from businesses and starting their own kind of 1099 or contracting work?
That, or they're just taking, like one guy I was reading about, took a job for a nonprofit. He's not making quite as much as he would, but
Hmm.
it's always interested him. And so how does that affect the economy? Well, A, he's still employed, but B, that shows up as a stat as a new job generated. So that
Okay.
affects that 6.36% unemployment.
I I've seen since COVID, there's been a lot of people that went into the self-employment part of this. I'll call it a sector,
Hmm.
and which is great for them. But I can imagine, like anything else in life, there's going to be a balance of it. There's going to be a flow towards a bunch of people wanting to be self-employed and wanting to be 1099 and trying to do things on their own. And then there's going to be another reset within they're going to go back to an employer because things may not have worked out the way that they thought they would, or maybe it's just a lot easier if they don't do it on their own, if they have and they're with a company that can provide all the resources they need. So I can see that thing ebb and flow for a little bit. I did notice a bigger surge, obviously, in 2020 because everyone was at home, right? They couldn't they couldn't
Right.
do anything,
Right.
couldn't go to an office, so it made sense, right? But time will tell.
Yeah. The only time I'm not happy that I went into a business for myself is tax time. Because when I was a W-2 employee, my employer handed me my W-2. Of course, it was my company, but still, it was,
Yeah.
they gave me a W-2. I filled that out and filled out the form and said, thank you very much. And even though I'm giving an accountant all my stuff now, I'm getting 1099 INTs from Allied and FCI and BiFi and collecting this and that. And I got socked last year because I missed just one.
Yeah.
And the service came back to me and said, "You didn't report this." They're right. We goofed.
It seems every year I try to get taxes filed for the business and for myself by, the March or the April 15th, and for businesses, March 15th deadline. And it seems like there's always something that I can't get done because I'm waiting on something else from somebody else. And so it
Yeah.
seems like, thank God they allow for extensions, because I don't know if I can ever file my taxes on time when they're supposed to be filed instead of filing extension.
Right. What else is going on?
Well, I wanted to bring up a subject today about kind of, um, the positives about a fund. So we hear about funds all the time, different types of funds: mutual funds, real estate funds, equity funds. Ours is a debt fund, and it may not fit everybody, and especially shouldn't be all of your eggs in one basket type of thing. You definitely
Right.
should spread out your retirement and your wealth through other vehicles of investment, whether they're passive or not,
Mm.
whether some passive or slightly active, however you want to describe it. But pretty much any investor that starts to get a sizable amount of money, they really do need to diversify that type of passive income in different verticals.
Right.
And the fund is really a great way to do that. But I see a lot of hesitancy in people wanting to do that because I think they have that fear of, like, the money is locked up really long term.
Hmm.
And one of the pushbacks that I would get about a fund in the past and recently is just they would just feel like they don't have control of something, or they don't own something. So I wanted to hear kind of your feedback on reasons why that really shouldn't be a big concern for someone.
Well, we could start a fund that has a minimum 2-year investment period. How would that be?
That'd be great. Yeah.
No. Oh, why don't we do that? Okay, we've done that. That's right. That's right. Um, Go ahead.
I mean, it's funny that you say that, but what are CDs, right? CDs
Yeah.
are, 6 month, 1 year, 18 month, 2 year, whatever. If you do a CD with a bank, you're locked in that period anyways, and you're making a significantly lower amount. So what would be the disadvantage there with a fund? Well, really, there is no disadvantage. It would be even better because you know that you're making more return and you're in the same lockout period, right? But
Right. And so, I mean, for us, obviously, we wouldn't want all of our investors to get in and get out in 2 years and have that be their strategy. But where else are you making 6.5 to 8% on a 2-year investment? And hopefully, you'd like us well enough so that you stay in a lot longer than that. But that is
right.
a strategy.
It seems like most people that I've done one-to-one deals with, and we talked about this in the past, is that after they get that payment stream coming in for a while, they get a couple of payments coming into them that are their profit payments, or maybe their principal and interest payment that they're owed. They like that, and they realize, I didn't have to do any work. I don't have to make any phone calls. I don't have to drive to a property. I don't have to swing a hammer. I don't have to call a realtor. I don't have to and they think about it like, oh my God, I made this money very passively, and I have security with it, high security and a lot of passivity. And it just makes more sense to keep the ball rolling, or add more to it. Or they just keep that money over there working the way that they want, and the rest of their money they kind of work more actively. So I I see it's like a trial by basis type of thing, where you
Yeah.
have to get involved with it and get some of these payments coming in. You're just like, oh, okay, I see it.
Right. And I don't, I mean, I don't need to belabor the point here, but um, so Gita, my significant other, gets about $2,000 a month from the various notes that she's invested in. And every once in a while, she comes back in. I mean, she's a professor. She works hard. She's always worked hard for her life. Doesn't make a ton of money or anything like that as a professor. And she goes, "Wow, I did absolutely nothing, and I made $1,950 or whatever it was, this year." And she's just tickled pink, And it's kind of funny. She knows the reality. I know the reality, but it's kind of a nice feeling sometimes, I think.
I always tell everybody that the first time that they invest in a note, I was like, you will be hooked. You won't be hooked because you know what's going to happen. You'll be hooked when that first payment comes into your bank account, and you realize, okay, I know what I've had to earn in the past to get money to come into my account. Now I'm not doing anything and that money's coming into my account. It feels really good.
Yeah, yeah, I like it. So I think just the instability of the market right now is causing people to just pause a little bit and say, where are they going to put their money? And a nice thing about mortgage notes, whether you're buying individuals or not, is that they're stable. So are you really going to go wrong if you buy something and you make 8%? Well, yeah, you may have missed the very top of the market at some point if you get 8.5 or 9 or even 10, but it's going to be a much riskier product.
Yeah, it's like, when do you fill up your gas tank, Richard?
Yeah,
At what price point do you wait as long as you possibly can for it to get to? In California, I'm probably sure it's like $4 or $5 per gallon. But
right.
if you're like, okay, when it hits 4.25, I'm going to go fill up my tank, Gee's tank, the 2 10-gallon gas cans that I have. Like, is that what people do? Like, some people may think they should do that, but they don't. That maybe they don't understand the amount of time and the energy that it takes to wait for that, or when you can just be like, just fill it up when you need to. That's the
Yeah,
same thing with real estate investments. Like, people will sit on the sidelines for years,
yeah,
2 or 3 years, and they'll hold on to significant amounts of money. And there's nothing wrong with it. It's just, you know, there's a huge cost that money costs you by waiting for something, that the perfect deal.
right,
There is no perfect deal. It's just what fits your parameter that day. That's what you go after, and you repeat and rinse. The more that money is working for you, the more it's just making for you, making for it. If it's sitting idle for a long time, it's really diminishing your return, because you're making nothing and you're losing because of inflation as well.
right. I'd have to check this just to make sure, but I think at the Entrust Group, which is who I use for my IRA custodian,
Yeah.
I think they said that 30% of their total assets, now that's assets that their clients like me are controlling, is sitting idle. People are doing nothing with
Yeah.
it. And if you think of the cost of that, that's amazing.
So they take the money out of the traditional stock markets and other standard investments like that, and they realize, I don't want to be in that environment. Okay, that's great. You made one decision. Your second decision, okay, where can I put it to where I can choose to where I can make the investment decisions myself? Okay, you put it
Right.
with a specialized custodian. Okay, great. And now it's there. And then what do you have to do? You still have to go out and find the investment, right? So I think there's some timidness about, they're not sure what's best to do,
Right.
and everybody wants the lowest risk with the highest return deal. That makes total logical sense. We all wish we could find that deal all day long and
Right.
fund it with everybody else's money, including your own, right?
Right.
It doesn't happen that way. You have
R-
to understand what investment makes sense for you. Do you want to be active with it? Do you want to have a rental? Do you want to sell horses? Do you want to invest passively with another professional that does do this for a living? Like, there's just
Right.
a multitude of things, and you have to figure out what you want to do. But the worst thing you can do is have that money sitting in the account, not doing anything.
Yeah. Which a lot of people do
Yeah.
just that. I mean, I'm probably guilty of keeping more in my checking account just as rainy day money in case all the banks stop or, we get hit by
Yeah.
the hurricane or whatever. But beyond that, I'm fully invested as much as I possibly can be because
But you have a plan. You have X amount of dollars that you put in this account. You have
for sure.
Y amount of dollars that you have in this account, and you have Z amount of money over in this account, and they're all working in a different bucket and a different vertical how you want to. So the entire portfolio is strong because you're diversified and you have a plan. I think most people they can't figure out the plan. It's not like they're not intelligent enough to figure out a plan. They're really unsure as to what the next step is. They know they didn't want to go to the standard world. I want to be in this real estate world, but I just don't know what the best vehicle is. So they just need to have better education out there on what to do.
Yeah, the downside of a self-directed IRA, because a lot of people say, "Oh, it's wonderful." Vanguard's charging you 1.5 or 2 points or whatever it is.
Yeah.
And a self-directed IRA is charging you maybe all in an eighth of a point, and this is wonderful. But it's self-directed. You've got to tell them where to put it.
Yeah.
You have to make those decisions. And I think even though people hear that, it doesn't quite sink in until they realize that their money's been sitting there for a while.
They love the idea of it's control. I control the investment. That's awesome. That's what I want to do. But when it comes time to put, ink to paper, it's you freeze. It's like
Right.
getting what they call it on your wedding day, cold feet.
Right.
You're getting cold feet with the investment, and it's perfectly natural to think that way because this is the first time you've had a chance to have a say-so with your retirement money.
Right. So, to that degree, we didn't talk about uh, discussing this too much, and I won't go down this rabbit hole too far. But exactly what you just said is an advantage of doing an installment sale trust, setting up one, because you can sell off your real estate or whatever. You can put it in a trust, and you can direct that trust to
Yeah.
buy notes. How about that? And especially if you're sort of helping a person do that, it works just like a 1031. You're tax deferred, just like a 1031, but
Yeah.
it's something for people to think about.
So, Richard, the types of investments that we purchase are performing loans, or traditionally first lien. And
Right.
it's all secured by real property, whether it's land, whether it's a home on real property as well. So they're typically owner occupied. We do some non-owner occupied stuff, but the main caveats we have is two sections. We have newly originated loans,
hmm
and then we have seasoned loans.
Right.
And so the definition of a newly originated loan is exactly how it sounds. It's a brand new loan that was just created, just went to the title company and was just closed on, ready to sell to another note buyer like American note buyers.
But they've had to have made at least one payment on that, right? Or else we're considered the originator.
So there are ways around that. And that
What?
would be you can buy it at the funding table, but you don't
Mhm.
have to collect the first payment. You can make part of the purchase agreement that the person that sold it to you, person we bought it from, just collects the next payment or the next two payments that come in. And those
Mhm.
payments are deducted from the sales price. So they are actually collecting the payments. It's just
Okay.
we say, hey, look, in the future, we're going to start on month X.
hmm Okay. So what do you see as the offsets in terms of buying a season note? Let's say a note that's got 2 years of seasoning on it. It's a nice enough house, probably whatever degree asset, versus something like that you just mentioned that is maybe got one payment and answer it in the context of what different underwriters are bringing to us.
So let's back up a second and talk about seasoned loans. So the definition of a seasoned loan, just so that we don't get off track too far, is just a loan that has several payments already made. And so we look at it as something that has a proof of concept. So Richard and I look at a loan, we say, okay, seasoning is basically more than one payment, but we really say a seasoned loan is really somebody that's paid at least about 7 to 8 payments and beyond. And then we say, okay, that loan has really been seasoned. They've gone through a stretch of payments in a row that they've made before the next due date, and that's a seasoned loan that we can look at. A newly originated loan obviously is a brand new one. So your question was around the newly originated loans, like what's the glitz and the glam about it?
Hey, what's the offset? In other words, so you've got one, you have nice seasoning, you've got a payment history, you've got somebody who probably has emotional history, I'm sorry, emotional ties to that, versus something where somebody's just basically walking in the door. Why would you do that?
Yeah. A lot of it has to do with control.
Mhm.
So in one aspect, I have a note that's seasoned, a seasoned loan that shows a good amount of pay history and it shows the propensity for the borrower to repay.
All
That's
right.
a great attribute that we hold very high in high regard when we're valuing a note. The newly originated loan, what's attractive about it, Richard, is control. What do I
Mhm.
mean by that? So we help set up that deal that we are going to purchase. And what we do is we know that it's going to be written on the paper that we want it written on, meaning a professionally written promissory note and mortgage or deed of trust, depending on what state
Mhm.
you're in. There's going to be title insurance and a full title underwriting from a title underwriting company.
Mhm.
There's going to be a lender title policy as well to ensure it's a first lien. And you're going to see a settlement statement that shows, taxes are this, they're being paid out of, down payment. Here is all the costs associated with it. And then boom, everything's clean and done. The borrower is also being underwritten by a third party underwriter. That's just a guy that says, hey, they got the ability to repay? Yes, they do. They're not going to be in any sort of trouble in the future because this is a affordable payment based on their current income
So
and
we're meeting the
expense.
CFPB guidelines here, right?
Exactly. Dodd-Frank and CFPB guidelines. So
Right.
in one hand, a newly originated is control, is the sexy appeal to it.
Mhm.
And the seasoned loan, it's the propensity to repay. So they both have very strong attributes to them, and we weigh them differently based on different things. But that's the new sexy, Richard, is the newly originated loan. And as long as they're compliant and done with our requirement specs, it's a really nice deal for us.
So is there any difference in asset quality?
There can be. Typically, the newly originated loan is going to be probably a rehabbed home, which means they've got, updated mechanicals. They usually got, a newer roof. They usually got the inside elements of the house, cleaned up, of whether it's new drywall or new kitchen or stuff like that. It's typically like that. So the home is more sound. A
Mhm.
more seasoned loan, it may have been a while since the house have had some TLC in it.
Right. So is it fair to say also that for someone to sell an unseasoned loan, that they're not going to get quite the pricing that they would on a seasoned loan? And therefore our spread's going to be a little bit different too, right? A little bit better.
Yeah, the pricing does weigh into that, and there are numerous factors, as you know, Richard, about valuing a note and what it's worth and what we're willing to pay for it. So, by definition, a newly originated loan will have a larger discount, as we call it, when we pay for it, meaning you hear the terms like cents on the dollar. There'll usually be a range of, like, let's say a grade A paper that we would find, which is a really well written
Mhm.
paper with high
Mhm.
quality attributes to it. It could be, in between the 85 to 95 cents on the dollar to pay for it, meaning we'll pay that much of the unpaid balance. And perhaps a newly originated loan, we see a little bit more risk to it, and maybe it's just going to be less than that. So by definition, a newly originated loan we will get a better deal on it, but we're also assuming a little bit more risk because we haven't seen the propensity to repay, even though we have everything else laid out.
All right. So we're making money by just letting it season,
Yes.
by just letting time pass and seeing if the flowers grow, right?
Yeah. So the most interest per payment the borrower will ever pay is obviously the first payment that they
Mhm.
make.
Right.
The least amount of interest a borrower will ever pay on a payment is the last payment that they will make.
That's true. Right.
So owning a note in the beginning of its life is very advantageous for a lender because there's a ton of interest, which is why banks will sometimes either sell a loan quickly or they may hold it for the first year or two and then sell a loan to someone else because they're basically they're capturing all the interest they can from the loan, and the unpaid balance moves very, very, very slowly in the first, few months, few years of the life of the loan.
So you think the banks thought about that when they created amortization test schedules?
Eighth wonder of the world, right?
It is. I think so.
Compounding interest.
I think
Yeah.
so. That's right.
And amortizations.
That's right.
That's what they do.
Well, that is always all very interesting. I like it every time I hear it in terms of explaining that. Um, and there's a lot of different ways for people to make money, and certainly to make it legally, but also to make it smartly. And I tend to think that a lot of people who are investing in notes with correct underwriting and things like that are investing smartly by diversifying their portfolio. And I always want to emphasize that I'm just talking about diversifying. Nobody should put 100% of the notes or portfolio into notes or mortgage or real estate or anything else.
Right. Exactly. All right. That is all the time that we have for today, Richard. Thanks for being on the podcast again today and
Okay.
shepherding me through this fun little topic with season notes and newly
So does that
originated loans.
mean by the next time we open it up, you're going to be able to give me the outcome and a blow by blow of the Red Sox game?
Well, the game isn't until April, so depending on when this episode's recorded and the next one's recorded, it may be
All
another episode till you find out the answer. But yes, you will know.
right. Okay. All right. All right.
All right, everybody. We'll see you in the next episode. This is brought to you by American Note Buyers.
Okay. Bye-bye.
Thanks for listening to Be the Bank. We hope you learned something from today's show. If you enjoyed this episode, please rate and review us. Plus, check out our channel on YouTube and follow us on Facebook and Twitter at Be the Bank and on Instagram at Be the Bank Podcast. Be the Bank is sponsored by American Note Buyers. Thanks again for listening.